Welcome back. Short break, right? So we know the overall picture, right? We know the overall picture. To just simplify it, demand zones are the highs. Sorry, demand zones are the lows. Okay, the lows. And then supply zones are the highs. So major highs and major lows. By major, I mean, if I say a major high, I mean a high that has caused a significant push downwards. By major low, I mean a low that has caused a significant push upwards. Those are going to be looked at as supply zones in other people's contexts. Yeah. So for us to wait for price to tap into this area so that we can trade up, it's going to take time. Okay, this is a monthly chart, and our analysis always starts with a monthly chart. So what are we going to do? If we want to trade in a certain direction, the trend is your friend. There is a simpler way of finding trades, and by this simple way, or a simple way, is by finding a bias. So you trade in the direction of the bias, and currently, and for you to find the bias, you have to implement the knowledge around swing highs and swing lows. So right here I have my swing high. If you look at this swing high, we are looking at this candle, and that candle. A swing high is a candle that has candles on the right and the left, candles which have lower highs. Okay, the high of this candle is lower than the high of the swing high, and the high of this other candle is lower than the high of this candle. The highs, not the openings, but the highs, that week high. Okay, so a swing high is validated when the third candle is traded through. So you see this here, this third candle is traded through here, and price closes downwards. Okay, so it's a valid swing high, meaning the market makers are going to protect this swing or this price level. What price level are we talking about? 1.41993. So markets are going to protect this high until here we have a place of liquidity. Some people may look at it to be a demand level, and if we're to look at it as a demand level, they will look at this. Okay, so this is where the concepts I'm talking about are very different from supply and demand analogy. Okay, why? Because for supply and demand, this is where you plot your demand. Okay, but I'm looking at this level, this bottom line here, 1.29207. Looking at this bottom line here and these wicks, this is where my interest is gonna be, because price has to reach down deeper into these levels. Right here we have a bullish order block, which is the last bearish candle. Okay, and price did not retest it, meaning it's untested, it's unviolated, meaning it's still valid. Okay, so I'm looking at price reaching into this order block and then it trades higher. So around the laws of swing highs and swing lows, once the third candle is validated, you're supposed to trade lower until the next swing low. Okay, so I'll count. There is this swing low, yes, but I'm going to count this one. A swing low has two candles, immediate candles on the left and on the right, whose low is higher. So the fractal indicator did not consider this, best reasons known to itself, but this is a swing low here. This order block is a swing low. They are candles. Okay, this candle, this bullish candle, validates our swing low. This bullish candle validates our swing low. Why? Because the third candle is traded through. Okay, so the market continued to be bullish until it met a significant swing high. That's when it turned. So we are expecting the same to happen when the market comes to this level. Okay, when the market comes to this level. So the reason why I'm having my demand level plotted like this is because the short-term demand zone is here, okay, and our interest is going to be here. Now if you look closely, the top of the bullish candle, okay, is right at the bottom of that square or rectangle, whichever you wish.